From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. The bond market's closed, but here we are. Bloomberg Real Yield starts right now. Coming up, cooler than expected U.S. inflation, investors rushing back to junk bonds, all with eyes on a potential Fed pivot. We begin with the big issue, a 7 handle on U.S. CPI.
Inflation starts to come down.
Supporting the case of inflation rolling over.
There's, some evidence that we are moving from peak inflation.
The market was starved for some good news on the inflation front, and we got that.
It does support, I think, what is the Fed's leaning towards wanting to downshift.
I don't think the Fed's going to have to do 75.
This is like being on mile 20 of the marathon. You still have 10K to go.
I don't think the Fed is going to stop because of this one number.
Inflation expectations have ticked up a little bit.
I think we're going to see yields come much lower.
I would be extending duration and fixed income.
There are a lot of cross currents that people are not really addressing.
Things aren't as scary as they might have been, but they're far from good.
Joining us now, PGIM's Lindsay, Rosner, Creditsights, Winnie, Cisar, and Luke Hickmore from ABRDN. Lindsay, I want to start with you. That October CPI print, was that really a game changer for the Fed?
Yeah, I think it's important. It is just one print. It's in the right direction. Inflation is not slamming on the brakes. It's tapping. So I think we've got to look forward to the next numbers. All of them will be very important as well.
Winnie, what about you? Weigh in here. Has your Fed call changed at all in the wake of Thursday?
Our Fed call has not changed in the wake of Thursday because we were expecting that the Fed would be a little bit more dovish, certainly than Chair Powell's hawkish commentary at the November press conference ultimately was. We were anticipating a 50 basis point rate hike in December. Market pricing is now coming back toward that level after pricing in about 60 basis points of hikes before that CPI print. And then we actually expect the Fed to be on hold because we do see signs of progress that monetary policy is working to address inflation, and those long and variable lags that the Fed really highlighted in its policy statement this month are going to start to materialize.
And Luke, that seems to be the consensus, that the Fed will ultimately be less hawkish than Powell has sounded as recently as last week. But I want to take this international. What is the easier call right now? Is it the Fed or is it the Bank of England?
I think it's actually the Bank of England, in the sense that we're going to face a nastier recession. We're going to see unemployment rise quicker. I think it's a lot easier to pick a 4% ceiling for the Bank of England than a 5% ceiling for the Fed.
Well, let's talk about the ceiling for the Fed, because it was striking to me. If you look at expectations for the Fed's terminal rate, at one point yesterday, there was an entire 25 basis point hike priced out of the market. And you saw risk alleys just go to the races in response. But Lindsay, is it premature to price out that magnitude from the terminal rate?
No, I don't think so. Really, the market is coming to what we believed would happen. We've thought that the Fed is going to go 50 next and maybe another 25 basis points and then take a pause. We all know that monetary policy works with a lag. Maybe it's a year, maybe it's 2 years, but the conversation is one that everyone understands to be that it is a lag. So we think that the market is now coming back to where we are and that the Fed isn't going to have to get to 5%. Remember, their dot is aspirational. It's not necessarily operational.
And so if the Fed actually does pause, if that becomes more of a conversation after some of the data we saw this week, Winnie, let's think about what we have until the Fed's December meeting. We have another CPI print. We have another employment print. Does the stakes on those just raise as we get closer and closer?
I think that the stakes of them are important, but also the Fed is not looking at one data point in a vacuum. There's always a number of other things going on in the economy, monitoring Treasury market liquidity, monitoring how the credit markets are functioning in general. So while we're focused on those data points, we're also not trying to just lose sight of everything else that's going on in the market right now. And there's some pretty strong evidence that policy tightening is working, at least from a liquidity perspective, taking liquidity out of the system.
Tightening is working. Of course, we have a big lag there. We heard that again from the central bank last week. But what caught my eye, just in the last hour, we had some headlines from Boston Fed President Susan Collins, who said that I think that as we have raised rates, that the risk of over-tightening has increased. And Luke, I want to bring that question to you. At this point in the game, what's the bigger risk? Is it over-tightening, the Fed doing too much, or calling victory prematurely?
I hate to say this, but both. The Fed always does too much. They always over-tighten. They've got to see unemployment higher. And until that happens, along with inflation coming down, they will keep tightening. Yes, they'll reduce the amount of 50 to 25, but it's going to keep going up. I think the biggest risk is people think they could be on pause for a long period. And that's the big narrative we're all hearing. I think one of my biggest non-consensus calls, it's going to be quite a short pause before they realise they've gone too far and start coming back down, maybe in the summer, maybe as early as the summer next year.
Maybe as early as the summer of next year. Winnie, what's your base case for the Fed at this point?
So our base case for the Fed is that pause, and the pause is actually a relatively new development in the market. I think until recently, consensus and at least what Fed funds futures was pricing in was almost an immediate reversal, kind of a cut and run. But I think the market has gotten some confidence around the recent CPI data and then also the strength in the labor market that perhaps the Fed can sit on hold. And we still are a believer in that bumpy landing. You know, there is the risk that the Fed's policy tightening is a little bit too cool, and all of a sudden they're offsides again and having to chase the inflation number with incremental policy tightening next year. And also that we over tighten and the Fed just kind of blindly hikes rates into oblivion and then has to cut and run. But I think that given some of the commentary we've heard from the Fed, from Fed Chair Powell, that we feel like a pause is actually a reality.
Cut and run. I have not heard that phrase before. I'm absolutely going to be stealing that. But Lindsay, I want to bring this to the yield curve because it was striking. If you look at the 2s, 10s Treasury yield curve, we got as low as negative 62 basis points already this month. Right now, we're floating around an inversion of about 52 basis points. It feels like the flattening, the inversion, this has been one of the consensus trades this year. How much juice is left here?
That's not really so much a focus for us to play that curve so much more. I mean, as you mentioned, we've seen a huge move already. I think it's a helpful indicator if you look at 3-month tenure. If you're thinking about recession, people hang on this 2s, 10s to think about a recession indicator. Not sure it's the right one and not sure it's the right one to be playing. I think the more important thing is figuring out the destination. So where is the Fed going and how long are they going to stay put? What that means for economic outlook, both here and abroad. And that's really where our focus is. I don't think it's one about 5 or 10 extra basis points in a steepener or a flattener.
Is that the sort of range that we're playing with, though, on either side, 5 to 10 basis points? And I'm not exactly asking for a trade here. I'm just wondering about the direction of this curve. It's obviously in deeply inverted territory. How deep can that go?
I think it really stays around here. Maybe it could flatten a little bit more.
Flatten a little bit more. All right, we'll see. I've heard some calls for 100 basis points of inversion. Obviously, there's a lot of daylight between now and then. But I want to get to the news of the day. Of course, this is a fixed income show, but one of the biggest headlines on the terminal today is that we had crypto exchange FTX file for Chapter 11 bankruptcy. And I don't think there's a huge amount of overlap between bond investors and cryptocurrency investors. But that being said, let's talk a little bit about the spillover effects here. And Luke, I want to go to you on that. Do you see any contagion risks here from what is happening in the cryptocurrency market?
There will be contagion. We don't know where it's going to be and when it's going to be because of the complexity and the interfirm lending, all the mess that FTX have got themselves into. That is not going to be the only place it's happened. And clearly, it's not the only time it's happened this year already. So far, it's clearing fairly cleanly. We're seeing things like the digital coins like USDC and USDT are fairly stable in all of this, and those are the ones we really have to watch for contagion. If they lose the buck, much like a money market fund losing the buck, they have to liquidate real assets. But so far, that's fine. So right now, we're probably okay. We're not seeing that broader contagion. It's contained within this one market. But you have to remember, this is a consumer-led market of technology-driven companies that people are getting hurt in, and they're hurting horribly. So, you know, they're going to feel less wealth. They're going to spend less money with all of that. But I don't think it's big enough to make an economy-wide impact as yet.
So maybe no systemic risks here, but Winnie, I want to bring you the same question. Is there any contagion risk from this cryptocurrency spillover fallout? And what does that actually look like?
So I think that this is an interesting question, because one of the things that surprised us this year about the broader markets is the lack of a true liquidity event in such an aggressive policy tightening and so many compounding factors: Russia, Ukraine, just inflation running rampant, all of these headwinds that are kind of knocking investors off sides. And the fact that we haven't seen, you know, the UK's pension LDI issue result in a severe blowup because the B of E stepped in, or the crypto markets being as volatile as they have, and now this FTX bankruptcy not driving a pure liquidity event kind of on the heels of it, is a little bit of a head scratcher. But I think that speaks to how much liquidity was injected into the system in 2020. And if you look at just U.S. cash levels alone in money market accounts and prime funds, they're at all-time record levels. And so that indicates to me that there's still a lot of cushion in the system. And when it comes to crypto, the big question is there institutional leverage in the crypto space that is ultimately going to impact other asset classes that are more liquid and can fund redemptions? And for the point right now that we're at, the answer has not been yes. But there's still, you know, a long ways to go in terms of assessing what the real outcome is.
A long way to go and a lot of questions. Lindsay, Rosner, Winnie, Cisar, and Luke Hickmore, everyone is sticking with us. Up next, credit markets surged by the most in 2 years after that inflation surprise in the U.S. That conversation coming up next. This is Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. It's time now for the auction block, where we start in Europe, where borrowers pounced on the demand for risk and spurred one of the best weeks for bond sales this year, raising 58 billion euros. All but one of the borrowers had investment grade ratings. Meanwhile, in the U.S., there's been a pickup in sales as well, with $45 billion of high-grade corporate debt issuance this week. One notable name was Oracle, which had a $7 billion bond sale. And looking at the sovereigns, Thursday's 30-year Treasury auction stood out. $21 billion sold, with primary dealers awarded a record low share amid surging demand. Moving on to high yield, earlier this week, I had the chance to catch up with DoubleLine's Jeff Sherman, the $98 billion asset manager's deputy CIO over at DoubleLine. We spoke before the U.S. inflation numbers came out, but this is what he had to say at that point about high yield.
I'm not touching high yield today. You know, we think that there's been a little bit too much of this belief in the Fed pivot, the risk rally we saw in equities, and so it's looking a little rich again. But there are things in like the securitized markets, a little more esoteric, things like commercial real estate, where people are extremely nervous that, you know, for a double B portfolio, yield almost 10%. If you want to, sorry, I meant to say triple B. You want to go to double Bs? I mean, you're talking 12 and 13% yields. So, you know, you can make some price mistakes, is what we talk about in the bond market, right? When you have yield.
Lindsay, Rosner, Winnie, Cisar, and Luke Hickmore back with us. Winnie, let's start with you. Are you touching high yield here?
Well, I can't say that we're not touching high yield. We have a neutral recommendation on the asset class, but we do have an up in quality bias in high yield. We prefer investment grade right now. This is almost entirely comes down to relative value between US IG and high yield. IG is trading at a much wider spread relative to high yield than it has historically, whereas high yield has been really bolstered by some of the technicals with very little new issue supply, a higher quality market. So I can't say that we're not touching it. There's definitely some opportunities there, but we agree that there are some kind of up in quality opportunities that look even more attractive right now.
So Winnie, touching it neutrally on your weighting there, what would shift you in either direction? What would you need to see?
So in order for us to get more constructive on high yield, we need to have a little bit more fundamental clarity around a potential downgrade and default cycle. Right now, that feels highly uncertain with conversations around the Fed over tightening, a potential hard landing in the U.S. that is going to be significantly worse for high yield than it would be for investment grade. And when you look at these two asset classes on a dollar price basis, which effectively is compensating for investors for potential losses in a downgrade cycle, they're right on top of each other. So I'd rather buy IG at $85 than high yield at $85 right now.
Luke, it's an interesting question, one that I want your thoughts on. When you look at the relative value between investment grade and the high yield market right now, which looks more attractive to you?
I think as we go through the end of this year and into next, I'm going to be moving more and more into triple B and investment grade out of high yield. But an important distinction here for me is that that's about non-financial high yield, the industrial high yield. Those are the companies I think they're going to find 2024 actually pretty tough. 23, I think they'll be fine. Inflation's okay. Growth's slowing, but it's okay. Nominal sales are all right. 24 could be really tough for these guys. And I think we're going to get closer and closer to maturities and needing to refinance. And that's often the pinch point for high yield. So we're moving into that triple B space. You're still getting 5-6% yields off that. Much prefer that. But really, the real key trade, things like 81 in bank space at 10%. That is great value from investment grade companies that issue high yield debt.
Well, Luke, on that point that 24 could be a really difficult year for some of these companies, is that a recession call on your part?
Well, partly. Some of that's as they're going to go through next year. We're going to go through that recession. But let's remember what a recession is. That's a decrease in real GDP. We're still going to have reasonably good inflation numbers, high-ish kind of inflation numbers, and growth is going to be slowing, but it's not going to be too bad. 24, we could get 2% growth and we could get 2% inflation. That's 0% nominal growth, which is where you have a problem for high yield businesses who need that nominal growth to continue to pay down their debt.
Lindsay, let's bring you in here because embedded in this conversation about the corporate credit market is the default cycle. And at this point, we really haven't seen many defaults. Still, the default rate is historically low when you look at past downturns. When does that start to change, if at all?
Yeah, I think it goes to what Luke was just saying, which it's predicated on what kind of recession we have, what are the contours of that recession. It sounds like we have a similar base case in that we are predicting our kind of most probability in a moderate recession, not something super severe, not a scary 2008 style scenario. So we're not actually expecting to have that many more defaults next year. But I think it goes back to your question, are you in high yield or are you not? We're on the lower end of our allocation to high yield, but I'm really lucky to work with 150 credit analysts that can tear apart balance sheets, and we can actually pick the names instead of just buying high yield writ large.
And when you look at the high yield holdings that you do have, is that slated towards any particular sector or industry?
There are subsectors we like. Home builders is a good example of that. That may seem a bit surprising given what's happened to mortgage rates, but they're doing a really good job managing their backlog, land purchases. They're doing it through options more and more. So that's a sector that we really like. But it really is name specific and finding the names that we think we're going to get paid back on.
Name specific, definitely something to keep in mind, sort of as we maybe progress towards a actual U.S. recession. But Winnie, to that point, I mean, when I talk to people about the spread widening that we've seen both on the IG and the high yield side so far this year, the explanation that I get is that it's mostly duration risk. It's mostly interest rate risk. It's not necessarily concerns over quality or the specific credit risk there. Is that still the case, or is that starting to change at all?
That's a great point and a really interesting question because we have reached a little bit of an inflection point in the interplay between duration risk and credit risk. For much of the first, call it 6 months of the year, it was all about duration risk. And duration has still been damaging to portfolios in Q3 and into Q4. But now what we're seeing is spread decompression and much more dispersion across both markets related to idiosyncratic credit risk. And that's very typical in a policy tightening cycle as people are concerned about downgrades and defaults. It leaves a lot of opportunities for the credits that you can get right. And it also means that you have to be much more selective in your asset allocation strategy.
Lindsay, Rosner, Winnie, Cisar, and Luke Hickmore, everyone sticking with us. Still ahead, it's the final spread. The week ahead with a host of Fed Speak on deck and the G20 summit kicking off in Indonesia. That conversation coming up next. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. It's time now for the final spread, a look at the week ahead. Coming up, we have President Biden meeting with President Xi on Monday and the G20 summit kicking off in Indonesia. That's followed by U.S. PPI and GDP out of Europe. Then we get U.S. retail sales and ECB's Lagarde speaking on Wednesday. Plus, we have a host of Fed Speak coming up on Thursday and another read on inflation in Europe. But it's time now for the rapid fire round. We have 3 questions. Guys, I'm looking for 3 quick answers. Luke, I'm going to start with you. Does the Fed hike by 50 basis points next month?
Yep. Easy one.
I think we lost you for a second, Luke, but we're going to, okay, we got a yep there. Okay, Winnie.
Yes, they do.
Lindsay, what's your guess?
50.
Is the Fed's first rate cut next year? Luke?
Definitely.
Definitely. Winnie?
Nope.
Lindsay?
No.
Really quickly, has the 10-year Treasury yield hit its peak for the year, Luke?
Yes.
Winnie?
Yes.
Lindsay?
Yes.
All right, great stuff, guys. My thanks to Lindsay, Rosner, Winnie, Cisar, and Luke Hickmore. From New York, that does it for us. Same time, same place next week. This was Real Yield, and this is Bloomberg.